If you've been listening all year, you already know 2025 didn't play out the way most investors expected. Rates stayed higher for longer, volatility kept people guessing, and LPs were dealing with the whiplash of decisions they made over the last few years. Some sitting in cash, some watching deals pause distributions, and many rethinking their entire portfolio strategy. Today, LP sentiment is split right down the middle. Some are fearful and waiting, and others see this as some of the best buying opportunities in years. And so we're unpacking what's real, what's just noise, and how smart investors should be positioning themselves heading into 2026. And to break this all down, I've brought in the full best ever host crew, operators who are buying, raising, and operating through every part of this market. We've got Matt Faircloth, John Kasman, and Ash Patel. Collectively overseeing more than $250 million in assets under management and interviewing hundreds of guests this year across multifamily, office, retail, development, and private credit. These are operators who don't just talk strategy, they are working in it every single day in the field. And in this roundtable, you'll hear the biggest surprises that we saw in 2025, what patterns emerged from interviewing operators all year, how each of us is adjusting our own investing strategy for 2026, the red flags, green flags, and market signals LPs should be paying attention to, and the number one mindset shift LPs need if they want to make good decisions in the next cycle. By the end, you'll walk away with a clearer, more grounded view of the market and a framework for where to focus your time and capital moving forward. If you're an LP trying to figure out where to allocate capital, an operator trying to make sense of mixed signals, or just someone who wants clarity on what the next year might look like, this episode will give you an edge. And with that, let's dive in. Matt, John, Ash, thanks for being here. Ash, kick us off. What surprised you most in 2025?
Yeah, Pascal, I think the biggest surprise is that the statistics on the economy are still doing well. Stock market's still at an all-time high. All the metrics seem to indicate a healthy economy. I know the middle class often doesn't feel that, but I'm a big doom and gloom guy, and I've been wrong a lot. So I thought we were peaking in 2015, 16. I was wrong. But at some point, we've got to pay the piper. We've had the longest bull run in recorded history. It doesn't last, right? So I don't know when it's going to happen. I've been wrong about when, but at some point it's going to happen. And I think everyone should prepare, do deals accordingly. There's going to be a time where we pay the piper.
How do you prepare for that? I mean, to me, I'm thinking about, like, do I have a little bit more money in cash? Do I reallocate, money across debt funds? I don't know how the rest of you guys think about this.
With the exception of Matt, I might be the oldest one on this podcast, but we've lived through the 99, 2000 dot-com bubble, the 2008 crisis, the little COVID recession. And during each of those events, if you had a vast amount of liquidity, you'd be in an amazing spot. So if you have the ability, hoard liquidity right now, don't stop doing deals, but make sure you stress test the hell out of your deals.
Yeah. Matt, what's your take?
Okay, so a couple surprises are that, number one, that Ash has not started buying multifamily in 2025, just given the amount of deals that he's seeing out there. And I don't know if Ash has ever bought anything on the market. He's a good bloodhound finding off the market stuff. So all joking aside, because he's Mr. Beyond Multifamily, here's the real surprise I've had is that there's been what I see to be a bit of stagnancy. A lot of people just kind of are sitting on their hands and waiting. A lot of people dry powder, so to speak. I was just listening to your podcast earlier, Pascal, where you don't like the term dry powder or whatever. You people want to invest and achieve their goals, right? So, or maybe that was you, John. That was you, John, that said, I
was about to say, damn, he said the same thing. I feel like I just said that.
I don't know. You said that. You were talking about dry powder on the shelf, right? Yeah. John hates dry powder. But it is a real factor for LPs that I've talked to that are sitting around waiting. So it's like we're in that waiting place. And it surprised me that nothing has broke things open. The Fed dropping rates did not break things open. The stock market continues to pretend like everything is awesome, braced on the back of NVIDIA and everything like that. So I feel like nothing. We're all kind of like sitting around bracing and waiting for what, right? Meanwhile, behind the scenes, what I'm seeing, Pascal, is deals are getting done. But as I said before, a lot of them are getting done off the market. I'm hearing of more and more off the market transactions, direct buyer to seller, brokers passing things around quietly for things that need to sell that are in slight or real distress. So that's been surprising to me, that a lot of the pain and distress that is there is underneath the sheets and behind the scenes, and it hasn't made its way to the front page yet.
We're going to dig into a bunch of the stuff together in a group discussion here. But John, give us your surprise takeaway, and we'll come back.
Yeah, my surprise is kind of the opposite of what Matt just said. I'm actually surprised that there's any motion in the marketplace. Part of it is, for the last 10 years, I feel like every couple of years, we've heard that doom and gloom story that, hey, this is it. Things are going to collapse. You want to sell. 2018 was a time. 2020 was a time with COVID, which felt really real. Then it was 2022. We started hearing more. 2023, when all those loans were starting to come due and interest rates started to shoot up. This is the first time where we're actually starting to see some of the reaction of that, or some of the implications of that, start to hit the market. And it's not this overwhelming influx of new deals, but we are starting to see some of that backroom deal flow that's happening. We're starting to see deals that the banks are actually taking back. Mm-hmm. We're seeing operators losing projects. We're seeing stuff go to receivership. I have not seen that in 10 years. Even if you had a terribly performing deal, you could typically find somebody to buy it at a decent enough number to at least get out of it. And now there is no one to catch that falling knife. So folks who really need to sell are having to get creative with that. I just toured a deal last week where we couldn't come to terms on the number. Or guess what? They're open to creative financing now. So they're saying, hey, well, give us your best offer. Maybe we could do a seller carryback. That was not the case for the last few years. And I would say for the last 10 years, unless you had a really, really unique situation. So we are starting to see it. It's not, the sky is falling, but we are starting to see a situation where if you can be creative, if you can be well capitalized, you can find some unique off-market deals.
So I think you guys are pointing on something here, which is like, a lot of people say that now is arguably, if there's a lot of distress and people are waiting, that it could be one of the best times to be purchasing. And there's still, how much of it? Like $7 trillion in treasuries now. There is a lot of dry powder waiting for whatever, we think this bull run, falling or getting crushed here a little bit. How do you guys look at that? Obviously you're still looking at deals and you're still, making transactions. But a lot of LPs that just got crushed in the last couple of years are also very hesitant. Like, talk to us a little bit about that.
I was talking to a bunch of LPs recently, and it's interesting. The LPs that I've talked to that are what you would call like a heavy hitter LP, that had probably 30, 40 LP investments, like larger investor passive, really had a lot of things hit the brakes on him all at once. And so he just holed up, went to cash, that kind of thing. The reliable LPs that I've had that are into a deal for low six figures every time we've had something out are, for the majority that I've talked to, on the sidelines right now. And it's not because like, I'm going to just sit on my hands and wait for things to change. They're like, well, okay, 50% of what I'm invested in is not distributing right now. And of that 50% of what I'm involved in that's not distributing, I've already written off 20% of that. It's off my books. If it pays me, great. If it doesn't, that's I've already discounted to that point. So I think a lot of these folks have a lot of their net worth out already. And so I'm finding the interest we're getting is in new LPs, people that did not get in 2022, 23, 24, that are new or fresh to the market, that are maybe curious enough about what's happening and seeing a shift and want to get into something new. So I think that as a capital raiser, it's become even more imperative these days to go to new people versus go to your regular go-tos that are good for a check every time you have a deal, to believe in you. It's nothing to do with us. It's got to do with the alternatives that they're invested in, a lot of which are not going well all of a sudden.
Matt, to build on that point, I think it's not just new investors, but investors that you have a strong relationship with.
Yep.
The investors who knew me and know me before a deal, and a deal is not where that relationship started, they are open and willing to invest in our next deal. We just sold a deal last week, and those are the conversations we've been having. And it's because they're not constantly seeking investments. They're not, the professional investor or the full-time LP investor, where if you are across multiple deals, that's exactly what you've been facing. But if you've invested with one person, one operator, because you have a strong relationship, and that person has generally performed, then they have been more consistent and more open to reinvesting in future deals with that individual. And to your point, if you have some baggage there, you invested in 10 different deals, seven of them are not working, 2 of them you may end up, losing everything. Yeah, that person's going to sit on the sidelines moving forward. If you've only invested in 1, 2, or 3 deals, and generally those deals are performing, you've been isolated from what we have been seeing in the market. And I think of it as, Ash was talking about the economy. Well, when I was younger and working in corporate America, I'd hear people talk about that all the time. But guess what? If I was getting my paycheck, none of that really mattered, right? It only matters when layoffs hit you or something's impacting your bank account. As long as you're getting paid, you're not really thinking about, oh, okay, well, hey, 72% of people are. Who cares what those statistics are? Your experience has been good. They're usually going to reinvest because they trust you as an operator. So I think it does really matter about building strong relationships, which means getting deeper on those relationships, getting to know people, really demonstrating the value that you provide to them, and making sure you follow through on those promises or those conversations.
My world is a little bit different. So our last raise was for an office deal. And I can't tell you the number of LPs that came in. I had conversations with them, and they all said the same thing. I'm looking to diversify. I want to get out of multifamily. And then this is a great opportunity for me to knock multifamily, but this is just the truth. So a lot of these people had deals in multifamily that either fell apart, paused distributions, or some level of uncertainty. And, to the effect where I've had people that are in 10 multifamily deals and maybe 2 are still paying, the rest are not. So because of the great job that you people all did in multifamily, they're coming over into our world now.
You're welcome, Ash. Just for you, we did that.
But in all seriousness, John hit the nail on the head also with the fact that we haven't seen this influx of toxic assets hit the market, with the exception of office, right? That's been beaten up, continues to get beaten up. There's opportunities there. At the Best Ever conference this year, I'm going to spend my time on stage teaching people how they can capitalize on getting into the office once in a lifetime buying opportunity that we have.
Talking about this topic a little bit, I think something that I've experienced in my LP journey, which I took a little bit more away from, was investing across vintages. I think if you are a newer LP coming into this space of alternatives in general, maybe you had a big liquidity event, you're thinking about inflation, inflating away the value of your cash. And you find the stock market volatile and you want to come into alternatives. I think one of the although I'm pro syndications, I have half my net worth in these types of things. I think the biggest thing to take away is that you should be investing across vintages. Like if you have $1 million, you're investing over 4 or 5 years in deploying that capital, because the people who invested a huge majority of their net worth or into these deals in their first time investing big lump sums into alternatives in 2021, 2022, all got hammered. And of course, that changes your mindset of getting into this asset class. Just like if you invested right before the Great Depression, you would have a totally different outlook on this entire industry as a whole. What's your take on that?
Pascal, I'm going to push back on that because, one, I think there's value in investing across vintages, but I think the message can get lost. It's really about understanding how you make money. The problem is on the deals you're referencing from 2021, 2022, 2023, many of these deals were based on buying a newer quality asset, very minimal opportunities to force appreciation or to create value because they were brand new, and using bridge or short-term debt. So you have this construction of a really nice asset, which looks great, but not a lot of room to create value. And you've got a short-term loan where you don't get to hold this thing long-term. So for the business plan, you don't have much control over being able to create value versus if you were doing a true value add deal and you could go in there and demonstrate how you're going to raise rents, how you're going to lower expenses, how you're going to increase the NOI. You have loan flexibility as far as when you need to pay it back or how you're going to refinance. I think that creates value. Then you get into cash flow. And I think that's where your vintage question comes in. If you have a portfolio where many of those deals are based on cash flow, some of those deals are going to appreciate over the long haul. Now you've got a nice mix where you can sustain whatever's going to happen in the marketplace. But again, I think many of those deals had minimal cash flow, minimal upside from a forced appreciation perspective, and you had the additional risk of not having long-term debt locked in place. That really became the issue. And to your point, if that's what you experienced as an investor, absolutely, you're going to be pessimistic about it. But it really comes down to the fact that you didn't really understand how to assess risk properly and understand where there was value and opportunity into a deal.
My 2 cents are market timing, right? I've got C-class, value add properties that are selling right now, either under contract or selling, and they'll produce, 14, 15% IRR for investors. I've got other C-class value add, but I bought those at a low cost basis pre-COVID, that kind of thing. But I've got other stuff that's valued and may sell at or below investor principal, right? But that was bought in 2022, 23, that kind of thing. And I've many, many friends out there. I'm not the only one. Me and John hang with all these folks and know these guys out there that are selling stuff, at total loss, right? It has to do with market timing. And I think that the multifamily, I'll throw some rocks at multifamily, right? Here you go, Ash. The multifamily investor base, syndicator base, lost a lot of its discipline over like the 2019. When things get too hot, that's kind of like one of those times where like, man, I probably should dap out of this, because there was a bit of a frenzy. And as an LP, maybe because everybody's doing it is the reason to not do it, right? So their multifamily got too much sunshine. It's still the best asset class, thanks, Ash. But it got too much sunshine from 19 to 22, I think. And because of that, it got overheated and it forced syndicators to force deals, and LPs, you shouldn't be able to go and raise $10 million on one Zoom call in an hour, but that was happening, right? So LPs were jumping in too quickly to things because that's what they thought other people were doing and whatnot. So there was an emotional frenzy for GPs and LPs, and we've seen this correction. So I don't know if it's, I'll push back on you too, Pascal. It's not specifically vintage or whatnot. I think there was a loss of discipline that happened in multifamily over in 2020 to 2023, but we've certainly got that back. And I think a lot of folks like myself and John are now looking at deals that are out there after the shakeout that has happened, and looking forward to 2026 even further, that I think is going to happen.
Yeah, Matt, but I think it's important for us to not dismiss the situation. I mean, the reality is it's not that multifamily changed. People got greedy, and they decided that
that's what happens
the parameters that they had and the criteria that they had,
just pick that mic up in front of you and drop it.
Listen, well, as someone who has been extremely frustrated for the last 4 years, right? Every year I have a goal of doing 4 deals a year. Every deal I've done 1, right? And it's extremely frustrating because you look around and you see people who started yesterday and they're coming around and they've got a $50 million deal. And I'm sitting there like, how? And I looked at that deal and I have no idea how you're going to create value out of that deal, right? And I'm scratching my head. But again, here's someone else. And I'm not one who likes to rain on someone else's parade, but it made me look internally to say, well, maybe you missed something. Maybe you're not doing something right. Maybe you need to adjust your approach. And I do think that what happens is there's so much competition. It only takes one. If you've got 50 groups, I mean, you know, if you sold a property anytime in the last couple of years, you may go and get 100, 150 CAs, right? So confidentiality agreements signed for people to look at your deal. And these are 10, 15, $20 million plus deals, right? So there are 100 groups across the country looking and vying to buy your property. You may get 20, 25 offers, maybe 5 to 10 go best and final. So you create this frenzy where now, to your point on the emotional side, people are starting to figure out how to win this deal. Even the language, win the deal, right?
Yeah.
No,
maybe
you're buying a property.
Maybe I'll drop my splits. Maybe I'll invest a little bit less in unit turns. Maybe I'll underwrite for
what if we did this kind of loan instead of that kind of loan? What if we? So then you start pulling all types of levers, and after a while, you get to a point where you're really hoping. And you're hoping that things play out the way you thought, and you have not baked in the level of conservatism that many folks like to preach about, and that's where things get really dicey. And unfortunately, yes, it's the market, but as investors, we're well aware that certain things can change the investment returns, and it's on us to bake some of that logic into the deal. And it's not to say every deal is flawless by any means, but on the same note, I do think it's too much of a cop-out to just step back and blame the market. No, take accountability. And going back to your point on operators, if you're going to look to invest with any operator, 2025, 2026 and beyond, make sure that person takes some accountability for any deal that is not performing in their portfolio. Don't blame the market. Don't blame interest rates. Don't blame something else. At the end of the day, we all can control what we can't control. You got to learn from it, create better systems and processes, and be a better investor and operator if you're going to go out there and raise capital from other investors.
So you guys see, obviously you guys are, you have a lot of peers, friends that are all operators. You know this space well, and you also know people who are doing deals that maybe shouldn't be, or you're, like you said, you don't understand how they're creating value. What is something that LPs should be focused on understanding the nuance around when they're looking at investing in deals?
LPs really ask the right questions, man. I mean, it's always like, well, how much money do you have in the deal? That's good question, but it's not paramount, right? That should be your first 3 questions. LPs should be asking like, give me like the best and worst case scenario. What's the worst thing that could happen? Like, what if you don't achieve this plan? What's the downside risk? What do you have as a backup plan in case this thing that you want to have happen doesn't happen? And what is, perhaps ask them for a sensitivity analysis. That's something we started doing a couple of years ago. We're like, okay, this is what happens if rents go up, if rents go down, if this is what happens if cap rates go up or go down, or those kinds of things. And an LP should be asking for more of a spectrum versus, oh, this deal is going to get me a 13.48% IRR. I mean, yeah, that's what the numbers say today, but then you close the deal and everything changes, and you got to be with the wind and change the dynamics of the operational plan as you move through the deal. So LPs should be asking more about what the pluses and minuses are when they're looking at opportunities. And I think that had they been doing more of that, had we been thinking more like that as syndicators, I think that we probably would have seen some of the downside risk that's there. And none of us really wanted to face what the real downside risk was about rates going way, way up, way higher than we thought they were going to.
Good point, Matt. But a lot of LPs just don't have the knowledge or the skill set to ask the right questions. I used to invest in a lot of different businesses back in the day, and maybe just out of laziness or actually self-actualization on, I don't know what I don't know, I assembled a team of people, former CEOs, attorneys, and they did a lot of the underwriting. They asked a lot of the hard questions. So for real estate, if you're an LP, get somebody to ask the right questions, because you can read all the books you want, Google, ChatGPT, but if somebody's pulling the hood over your eyes, you're not going to know it, right? So you have to get somebody that's an expert to help ask the right questions.
I love that, Ash. I mean, you're spot on. I think that's the challenge is there's not really a magical question. What I would suggest every investor do is really understand the story of the deal. And to Matt's point, the downside risk. You should absolutely ask, how do I lose money on this deal? What would need to happen in order for me to lose money? There's a scenario. I promise you there is. So if that operator is not thinking of it and they tell you, oh, no, there's no way, it's blah, 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 run. Because that just tells you they're not really thinking analytically about it. They're not being transparent. There's obviously something that can always happen. Any good operator, those are the things that keep you up at night is that doomsday scenario. And you're trying to figure out how to mitigate that as much as possible. So ask that question. And that's going to give you a sense of how they think. What have they done to mitigate that risk? At what point do they pull the levering and go to plan B? Those are the things that you want to monitor. If I could give a quick little anecdote, right? So the deal we just sold last week, that was a deal where we had a heavy renovation plan. We had a bridge loan. We bought this in 2021. So all the stuff we're talking about, right? As rates started to move and we started to get to our rate cap and above, and now we're waiting to get the reimbursement of our rate cap, we looked and said, hey, listen, I don't know how long we can ride this roller coaster. We got to get to a place where we can refinance. We've created a ton of value. We've pushed rents drastically, but I don't want to play this out and wait for rates to drop. I don't know when that's going to happen. Let's get to a place where we can refinance out of this, give ourselves a new start. We can really control all of the elements. And that's what we did. December 2023, we refinanced, we locked in a 5-year loan. We recognized that, hey, if we sell before then, we got a prepayment penalty. But in order for that situation to play out, it's got to be a good number, right? Those are good issues to have. We will deal with that. But the risk of maintaining that bridge loan was problematic. And again, we were comfortable doing the bridge loan because it was a pretty significant value add deal, even more so than we thought. We pushed rents from $939. We thought we would get them to $1,200. We actually got them up to like $1,800, $1,900. So incredible value add, which is why we said, hey, you know what? Let's go ahead and lock this in now. Let's run this for another couple of years, and then we can look to exit. You've got to be proactive in your business plan. It's what Matt said. I mean, you could go in day one and have a plan, but it's going to change. And that's why you have to understand how the operator's thinking about this. How are they evaluating the business? And that's something that we don't talk enough about. It's a business. We treat it like it's just a static piece of real estate, like a building, and you just put people in there and they pay you, but it's a business with people whose lives change, who lose their jobs, who get promotions, who move, who get divorced, who all of these things happen. We got to run it like a business. You got to sit down and can't just do the same thing you talked about 3 years ago. It's going to change. It changes daily. It changes weekly and monthly. So I think that's the important thing is finding somebody who understands how to run it like a business. Like Ash said, get down, get some CEOs, get some people really, really smart and savvy to ask better questions. But ultimately, you've got to understand what the story is and just ask yourself, does this make sense?
I would argue that a lot of it
is telling me makes sense.
I would argue a lot of it is around just understanding what are the 3 biggest levers in the deal. And I think if you're a newer LP, they are the debt. The debt provider provides 80% of the financing, in most cases. And if rates go up, that is a huge, huge lever. The operating income of how profitable is the operating part of the deal is pretty much the second biggest lever, which has many sub levers underneath it, 2 of which the operator doesn't really have any control over. For example, property taxes, if we see mass inflation, and insurance. And so I think my take is like when you're going into these deals as an LP, you really need to understand what do you think is going to happen to these major levers in a deal, and you should have like a hypothesis of like you need to understand. Do you think rates are going to go up or down over the next 5 years? Do you think insurance is going to go up or down? What do you guys agree, or do we have a different take here? I mean, it seems like John's hacking away. I like it. I like that.
Though we can't control those things. So, I mean, again, I think it's silly to sit there and try to project and even have a hypothesis. Buy a deal because it makes sense and give yourself some flexibility. So if something changes, you can react. I think buying deals based on those hypotheses is how we got here. People thought rates would stay low and they didn't. And now you're screwed. You thought, who was even thinking insurance was going to jump, 100%, 150%, whatever it is in some markets. Like, I think you get into a lot of issues when you start predicting the future. For me, it's more control what you can control, which really comes down to cash flow, which understands what's likely to happen based off of past performance. It's still not perfect, but I think it's the best indicator you have. How's the property performing? What's the business plan? When you talk about insurance and taxes, like what have you seen in the marketplace as far as tax reassessments, insurance costs? Have you gotten quotes? So you can control that to an extent. If in 3 years that changes, I think you've got to be ready to pivot and make adjustments and do whatever the market is telling you to do. But a lot of times we get stubborn and we go into a hope strategy and we hope that rates come down and we hope that insurance drops back to normal rates. And that doesn't normally come to play out. So I just think you got to react to the market. And sometimes you sell a property earlier than you want it to. And like you said, you make a little less money, but you live to fight another day.
Here's a question from Matt and John. Would you guys still do interest-only bridge financing on deals today at floating rates?
I would if the business plan made sense for it. So again, to me, where the business plan makes sense is the ability to force appreciation, where you've got a team that you believe in the execution. It's a proven, market data. The market data proves that you can get the rents that you're looking to get. You can drive up the NOI and create the value that you're looking to. Then yes, I would, because you probably would want to unlock that equity that you've created.
Yeah. I would also, as long as, like example, right? Let's say that a broker brings me a 90% occupied deal, and these are real deals that got done on bridge debt, right? Okay, 90% occupancy, you can push rents by $30. Because by going and doing a little bit of tweak or doing a trash valet or something like that, and I can push value a little teeny bit, just squeeze just another 2 drops out of the lemon. That deal should have never been done with bridge debt because there's just not enough value to be extracted from the deal. That said, you come at me and this is going to be a real deal that's going to hit the market next year. You're going to see more of this kind of thing. 50% occupancy. Owner ran out of cash and wasn't able to turn units anymore. 50% occupancy, 60% occupancy. You got to put half the property is down, mold, roof leaks, gang members living on site inside the vacant units, that kind of thing. That Fannie and Freddie, believe it or not, will not touch that deal. So John and I, folks like me, have to go in and roll our sleeves up, and you need to create value through something like that by me probably doubling or even tripling the value of the property by doing the work. Yeah, all in, I'll do bridge debt as long as it works. But bridge debt was like crack. Everybody was doing it because of how good it was and because of how cheap it was at the time and because of how much of your purchase price the bank was willing to throw into your deal. So it got misapplied quite a bit into deals that just didn't have enough juice to get squeezed out. And so before you know it, you get upside down. In that. So short answer your questions, not taking the bait, Ash. Yes.
I didn't know if things changed today where people are more conscious about locking in rates.
Absolutely, though. But to your point, Ash, yes, if you talk to most investors, my guess is at least half of them would say no to your question. No, I will not touch bridge debt. I think the issue there and the limitation is making bridge debt the enemy. It's not bridge debt. You didn't have the right product for the right business plan. Absolutely. And it's that simple. It's you can't just grab a product and say, okay, I'm gonna use this kind of loan. I'm gonna use this. Like, it's just the same as me saying, hey, we're gonna just start renovating. If the property doesn't need renovations, if you're not gonna get an incremental amount of money for rent, why would you do that? So I don't know. It has to make sense with the story and the business plan.
It goes back to your greed comment. It goes back to your greed comment, John. Bridge debt got overused because the greed gland kicked in multifamily, I think.
And John, maybe we need to have a second episode to hash this out. But I kind of disagree on a lot of these things. I think on my end, how I think about this is I think you need to have some sort of prediction about the future. If you are not making a prediction about the future, you should not be investing. If 5 years from now, do I think interest rates will be higher or lower? Do I think the economy is going to be massively affected by the increasing government U.S. debt? And what effects will that have across like every industry? And if
what if you're wrong though, man? You're placing
that's speculating. That's not investing. That's all speculating.
You can
it's
be
speculation,
wrong.
though. That's not investing.
Yeah,
you're speculating on the future.
I would disagree.
It sounds like you're placing a bet on a roulette wheel, man. You know,
I mean, are you not all doing that? I mean, you are making a prediction that what you're investing.
You're right. You're right, because both John and Matt both said I can get the rents up to here. How do you know that? You're betting on it.
I'm not betting on it. I'm looking at every piece of data in the market to justify it. I'm looking at market comps. I'm looking at everything that I can find to understand if there's enough people in the area that make the money, if there's enough demand for that. I might even run a test ad using another property. I'm going to validate that as much as possible before I make that bet. Every investment. So to your point, Pascal, every investment has some level of prediction, but there are things that are likely to happen based on elements we can control. Because if I'm wrong, let's just say I thought I could get $100, but I can only get 50. Well, guess what? I need to have a plan B to say, don't spend $10,000 on a unit. Then I need to cut that down to 6,000, 4,000, or 5,000 so I can pivot. So it's a matter of being able to control what you can control. I can't control interest rates and what they do. So if I made a bet based on interest rates being a certain number and I'm wrong, I'm just screwed. So that's what I'm getting at. Let
me give you an example. So in the United States and across the world, we have declining birth rates below the replacement rate. Okay. So at our current pace in 20 years, if we keep at the same pace, we will have significantly less people that need housing because there are less people on this earth and less people in America. So I can look at the macro factor and say, you know what? There's going to be less demand, and that is not good for owning multifamily real estate. You could call that speculation. Wow. I call that looking at macro dynamics and saying this doesn't make sense. We can argue about it, whether it's interest rates, whether it's the number of people who live in the United States, but and maybe I'm willing to die on this hill, but it's like you have to have some idea of what you think is going to happen. Otherwise,
But don't you have to have a backup, like a hedge, just in case that thing doesn't happen, right? And that's what I was going to get at here is with the we all are making predictions to the market, and I do believe that folks like when John and I are getting in and pushing rents to a certain degree, as long as I'm not pushing them above the market, I do think I've got data that the effort that John and I are making in renovating units is going to come true. You're talking about making bets on things or making predictions on things that I have 0.00 control over. I have no control over what happens to interest rates. I do have control over the velocity of renovations I can make in an apartment and how sexy I can make that apartment to determine if it matches the unit, the building next door, to see if if I can match his rents. But I like to have a prediction of downside risk if things that I predict in the market are not going to happen. Like
I think this is the difference between being an LP and being a GP, because this is your career. You are going to be in this career regardless. Yes. As an LP, you don't need to invest in real estate, right?
Well,
and so I think,
I find most LPs hedge though. Don't know LPs that like, okay, I'm going to place a few bets in more aggressive initiatives, and I'll go and get into a debt fund that's collateralized and it's got lower yield, lower rates of return. Probably not going to smack out of the park, but I'm probably not going to lose because it's a debt fund with collateral, right? I feel like the LP needs to hedge a bit more. The GP can be a little bit more of a theorist and say, okay, I'm going to push in this direction because this is my thesis that I'm going to create here, right? Whereas an LP can kind of say, okay, I like Matt's thesis, but I also like Ash because Matt's the multifamily guy, Ash is the beyond multifamily guy. So let me diversify my holdings a bit by putting a few bucks with Matt and a few bucks with Ash. Is that what you're saying? That's maybe a different.
I mean, I think it's where are you investing? I mean, Warren Buffett is making a prediction that we've been, Ash started this episode by saying we are on the longest bull run in history. It's got to come down at some point, right? I think it's just like, look, I think when you're a GP, it's like you operate in your asset class, and there are going to be seasons and decades where it's high, and there's going to be seasons and decades where it's low. But yeah, I think, different take. I respect, the way you guys are thinking about it. I think
I'm just trying to get over you bumming me out over the U.S. population dropping and everything like that. How we're all going to die off, Pascal. I'm trying to shake that off.
Hey, look it up. Look it up. It's pretty interesting.
I know. I'm with you. I'm with you. And it's there's the counter to that, by the way, is longevity. Is that Americans and people are living longer, and so. That's the counter argument I'll give. So that 30 years from now, and we're all sitting here old and gray, we'll all be still having this conversation, all spry and everything like that, thanks to advances in modern medicine. So there.
I would also tell you that correlation does not mean causation, right?
You are
so when you talk about the population growth, I mean, and the funny thing is, I remember I was talking to this guy when I lived in Chicago. This guy was investing in one of the roughest neighborhoods in the city, and his rents were going up. And I was a little bit perplexed. So I was asking him what's going on, because I drive by, and I mean, you can go through almost a whole city block, and there's like one house, and then like there's the next house, and it's because they've knocked them all down, and it's through blight. And the point is, you also have a lot of olding housing stock, which is now not relevant and not needed. So as you talk about, 10, 15, 20 years into the future, how much of the housing that exists today is going to be viable? So again, go back to it. We can't control these things. And sometimes we can get deep into the economics and look at data and all this stuff, and we reach the wrong conclusion because we were paying attention to the wrong thing. I'll go back to even something more recent. You look at markets like Austin and some of the hot markets in Texas and Florida, the Carolinas and Vegas, and all of these markets had so much population growth, yet they were the markets that got hit the hardest when it came to rent values. Why? Because people forgot the number one rule in all of the economy. It's supply and demand. And when that supply came online to meet the demand, rent demand dropped. So going back to that blight example, my buddy who was on the south side of Chicago was winning because he had the demand, he had the property there, and there wasn't a whole lot of supply to compete with him. So sometimes we overcomplicate this, looking at every single, website and magazine and data point that exists. It really comes down to supply and demand, and the rents will tell you the story. When rents start to go down, that's going to tell you the story. And then it's just a matter of, is this a temporary thing? Is this a bigger trend in the marketplace? And that's when you have the ability to react. So I think if you're actively in the market, you can watch this stuff real time and react accordingly.
I love it. Okay, well, definitely an engaging topic. I love that we got into it. I want to take a second and pivot the conversation a little bit. You guys are all hosts in your own right on this network. And I would love to go into takeaways that you've had interviewing different guests, or things that you've learned this year that maybe you'll take into investing next year.
I'll throw it out there. I've learned the riches and the niches, the people that are doing that are creating really interesting businesses that I think that I see to be thriving when I interview them on the show, are those that are doing something very unique. It's tough to repeat what they're doing. It's tough to duplicate it because they've got some sort of a secret sauce or some sort of a method.
Give us some examples.
Or angle of attack. Let's see. I've been guy doing developments in New York City on a city-owned piece of land through a JV partnership with New York, and he's also doing a development in Portugal. I'll tell you this: the multiple people that I've interviewed that are doing developments overseas or doing some sort of a real estate investment activity overseas, taking the blinders off about the United States and realizing that there's actually other places in the world that you can make money investing. Those are the folks that I found to be very interesting, because if you learn the rules, you can play the game over there. So that's been some very interesting conversations. On top of that, those that have figured out how to stay on the cutting edge of as tech is changing, like AI. Interviewed a guy that's using he turned his entire property management company upside down by using AI solutions for almost everything in the company that he had. So I'm not saying that's irrepeatable. You can still do that, but he's leaning into a changing curve in the way that we do business using artificial intelligence. So those are two examples of interviews that I had this year that I was like, oh, wow, you're doing a development in Portugal. That's interesting. Tell me more about that. And it opens up a million questions. How are you getting the debt? How are you predicting rents? What's the land ownership rights over there?
What currency exchange risk?
Yeah. How's all that work? Right. Yeah. It's actually fairly favorable. So, anyway, so those are some things that I came up, but all those folks were into a very specific, very tight niche. They weren't, trying this, trying that. They decided to lean all the way into one solution and one thing, and they were doing very, very well by leaning into just that.
Love it. Ash?
One thing that stands out with me, is a lot of the guests that we've interviewed this year, they're doing deals only if they're compelling. So it's no longer, oh yeah, it fits my buy box. Cool, I'll buy it. There's got to be something really compelling about the deals that our guests are doing. And really, everyone around me, it's no longer just building up your assets under management, following a business plan. There's got to be something extravagant about this deal, whether it's really good from a risk perspective or potential upside, or you got it at a great basis. But run-of-the-mill deals are not happening.
Yeah.
It seems like it just really has to be a strong conviction to buy this deal.
I would +1 on that. I feel like the sentiment has changed. If you're an LP investing in this landscape, it's less about growing AUM, and it's more about making sure that all of your deals are operating and performing, and maybe even taking a pause from acquisitions and cleaning up your SOPs and your management and everything on the inside before going out to market again. So I would highlight that. John?
Two things stand out to me. Really, and first of all, I think context matters. As you all are listening to the four of us talk, it's important to understand like where we're at respectively in our investing journeys and like how investing has helped us. And if you're not there, don't just take our words and run with it. You've got to invest for what makes sense for your goals. And the reason I say that is when I was starting off, I would listen to people who they could afford to sit on dry powder. They could afford to sit and wait and not buy a deal for 3 years because they had plenty of money in the bank. If you don't have that and you are trying to get out of a W-2 job and you're trying to figure out how to do that, make sure you have an investing strategy that allows you to move closer to your goals and not just waiting. So I have had a lot of great conversations this year. The two kind of flows of conversation stand out. One is for that person who really needs to invest now. They don't have the luxury of just cherry picking the very best deals. And you can find good deals today. It was a lot harder to find good deals, I think, a couple of years ago. But that average run-of-the-mill deal that Ash and the folks are passing, that's a great deal for you to get. It's not a home run, but you won't lose money. And if you are kind of in that early stage still, you've got to build that track record. You've got to learn. You've got to grow. You need deals like that. The flip of that, though, is on the operational side. Great conversations with people who are really, really honing in on the operations. I actually just interviewed a guy today. And one of the things he talked about was managing his expenses. Now, he focuses on Class C assets, but he talked about looking at water and power to the point where he is going and taking a look at the appliances in his units. He is looking up the models. He is identifying how much wattage and power they should be using. What is the life expectancy? And he's calculating the life expectancy of his existing appliances compared to what the average is and recognizing whether or not they need to do something different, whether it's changing the fuse prematurely or anything else. And he's saying they've come in within about a 3% accuracy of the life expectancy of some of these items here. That's just another level of operation that hadn't even crossed my mind. If looking at a refrigerator and being able to identify when will I need to replace this and how can I extend the life expectancy of this refrigerator. I'm not suggesting to go off and do that necessarily, but I'm saying as operators, for us to look inside and really, really hone in on our numbers and drive the efficiency, that's a great opportunity, I think, for us to drive value and to continue to grow as operators and do that for our investors.
Let me throw a quick anecdote because you talking about appliance make and model reminded me of something. The AI person that I talked to it's got their PM company and they integrated AI to turn the whole thing upside down. They put in they're doing a voice AI overlay, right? So you can talk to the AI bot, right? The AI bot, they uploaded the make and model for every appliance in their portfolio. The tenant tells them where they live. AI bot all of a sudden knows, okay, I know what furnace you have because I have it in the thing. If you're having a problem with your furnace, the AI bot will then go read the manual real quick. And it will talk you through the troubleshooting guide in the manual. Okay, try this, try that, try this. And it will then, if it can't talk you as the resident through how to fix that machine, then it'll call a repair tech. And this is all a voice AI bot that you're talking to. That's what's coming down the pipeline. And that's what I'm talking about like kind of like pushing into a niche. How crazy is that? This is beyond ChatGPT. They had to kind of take like an API overlay to make all this happen. But that's where the world is going. And I think that's really cool. Anyway, you just reminded me of that story.
Yeah, I mean, speaking about AI, as it's a big topic right now, I don't know, other than maybe in the acquisition and underwriting portion of real estate, how much AI will really affect operations in real estate. I'm imagining you still have to have a maintenance guy. You still have to have people running around fixing things. It's largely I'm sure there's customer support and whatnot. That's helped a little bit. Have you guys? What's your take on AI's affecting how you do real estate?
We recently had a team from Stanford, Oxford, and MIT reach out to us, and these were probably kids in their 20s. They reached out to us and said, "Hey, we can use AI to help you find commercial real estate." I said, "No, you can't." They're like, "No, we can. We're positive we can." I said, the problem is commercial, and when I say commercial, non-residential, is an inefficient market, right? You've got to read through every lease. You've got to find nuances. You can't use automation to underwrite our deals. So we spent, I had one of my team members spend a few months with them, and they finally just quit. And they're like, "Yeah, you know what? We can't do it." It can be used for things that are, inefficient markets, right? Stocks, commoditized real estate. But in our world, you can. But where we use AI the most is reducing our legal bills. We've saved a fair amount of money on lawyers with AI.
You couldn't, so they weren't able to figure out how to get AI to scour those leases, or is it because the leases are kind of behind an ownership wall to have access to? You have to find the deal, read the lease, find the nuances, that kind of thing. Because of is that the inefficiency you're talking about?
No, let's take a lease, for example, and, let's provide them all the leases. But if you take a lease, there might be certain out clauses where, Starbucks has a 10-year lease, but in year 5, they can leave if they want.
Yeah.
Or if their sales don't exceed a certain amount, they can leave. How do you underwrite that?
Right.
Right. You just have to apply experience and logic to it, but you can't apply automation to it.
It sounds like there's too many variables, right?
There's a lot of variables, which is why it's a very inefficient market.
Yeah. Okay.
Pascal,
I've heard people using AI to find deals, but to do it, you're typically scouring public record. You're just looking for the highest cap rate you can find in that. So it's probably too wide of a net, I think, for AI. Maybe there's a way to make it work eventually, but I've not heard people using AI effectively. A lot of people are pounding their chest and saying they're doing it, but I haven't seen it used effectively for finding deals yet.
Yep.
I think it's also on the operations side. One, I don't think it's there yet, but I definitely am seeing more and more people incorporating it. I mean, you talked about, looking at the appliances and things like that from an operations standpoint. I think a lot of it is legal, and some of the, with the leases that exist, it's automating some of those processes. Like when do you have the triggers for lease renewals sent out? There's a lot of things in there procedurally that you can certainly clean up. We're still playing around with it, quite frankly, to figure out what makes sense, because some of it requires more time and energy to try to teach the AI tool than just to have the PM do it. But I definitely think it's something that as folks get more and more comfortable with, you will start to see it play a bigger role in the future.
And I would love to kind of take a quick wrap this conversation around the idea of going into 2026. Where are you focusing? Where do you think the opportunities are for LPs investing in commercial real estate?
If I could, I would say Asha's been on to something for a long time.
No, don't let it go to his head.
No, but listen.
Him on the show, John.
Here's what happens.
Do it behind the scenes. You just did it publicly.
Happens.
Good God.
Here's what happens.
Matt, I love you.
Kissy.
Ash, the reason Ash loves non-multifamily is because I think you can create and find better value there. He just talked about the inefficiencies of commercial real estate. And I think there's value where you can play in inefficient markets. So for me, that's kind of the small cap multifamily space where I'm not competing with investors all over the country. They really can't be efficient enough to operate some of these smaller local properties. But I'm also not competing with someone who's looking for a house, a single family rental or 2-unit property. I think if you can find where there's inefficiencies, there's less demand in this market today. So you should be able to find deals that work where you can cash flow, you can create the appreciation. And that's where I'm banking on, the market in 2026 is really kind of this small cap multifamily landscape.
Love it.
John, caveat to that is, I asked Joe Fairless one time, I'm like, why don't you take all your systems, all your people, and get into non-residential commercial? And he had the perfect answer. He said, because it's not scalable, which is true.
Yeah.
In multifamily, you can build systems, you can scale. With what we do, again, being inefficient, every deal's so different. It's really difficult to scale efficiently. So that's the drawback. 26, we are dying for more office. We see these buildings go to auction for 20 cents on the dollar, and they cash flow 20% on day one, but they also have 50%, 40% vacancy. So it's like the Wild West of what real estate was probably 20 years ago.
That's interesting.
But it's not easy, right? There's a lot of ways you can get into trouble, but the opportunity's there.
That's interesting. Here's my 2 cents. From what I'm looking to create and the LPs that I talk to, and just where I think this is my what would you call it, Pascal? My prediction, so to speak, of where not a bet, but a prediction of where I think the market's going to go. I think LPs next year are going to be more sensitive to cash flow. The last 10 years have been an appreciation market. I mean, John and I have seen people buy a multifamily and sell it a year later at a 20% IRR and put it all over Facebook about how smart they are, right? They're riding an appreciation wave that's been very prevalent in multifamily and maybe in a lot of asset classes. I think that cash flow over appreciation is going to be what we're going to see be the king over the next 10 years. And that might be because rates are not going to go all the way back down to where they were before. I think we might have to learn to live with the Fed, with the 5 and 10 year treasury somewhere between 3.5% to 4%. It is what it is. And if that's where it is going to be, we're going to have to live on cash flow versus appreciation. That's number one. And I think the second thing that we're going to see be way more important to LPs, especially those that got burned a little bit over the last 5 years, is wealth preservation, right? They're not going to be looking to do things. They're not going to jump into the sexy 22% IRR deal if there's also a chance that 22% could go to zero or negative. And so I think we're going to see more affinity for deals that are producing 11, 12, 13% with more surety than stuff that's somewhat speculative in the high 20s or whatever it may be, which means that I think what's going to be successful as a GP, this is what we're going to be leaning into, is to creating more blended funds, so that if I've got a deal that goes well, one of Ash's office buildings or something like that, would it be great if that were blended with something that was a little bit more less speculative, not, whatever, so that one hand can wash the other a little bit. The probability of losing at all or not meeting returns is minimized by taking deals and merging them together through a blended fund. So that's what I think we're going to see more of in the years to come.
Love to hear the prediction. Hey guys, so thank you so much for joining me.
What do you think, man? You're not allowed to get out of here with that. You don't wind it up, Pascal. Come on, man. We want to hear what you break out your predictions for next year.
All right. Look, I have quite a bit of money in debt funds. I've got like 1.5 million across different debt funds right now. I think something that I am very focused on is Ash talking about the incredible bull run we've been on. And to me, I am in the middle of, some of the funds I'm in have gone from 18% to over 42% of construction loans. I have funds where they have a good amount of second position debt in them. And I think if you look at what happened in 2008, national average across the United States, properties fell over 30%. Some markets fell closer to 50. And if you're in debt funds that have second positions, or they take on a lot of leverage and the bank sits, maybe the operator does first position loans, but the bank sits in front of you and they have 1.5 to 2x leverage in the fund, then those are not positions that I want to be in. And so I am personally, in the middle of researching different funds and trying to move away from what I would consider riskier places to allocate my capital, and willing to take a little bit of a haircut on the return in order to do that. And I would not be surprised if more investors that are in debt funds think that way. Take?
I think you're right. I think that there right now is not the time to get aggressive. I think now is the time to be looking for under the sheets deals. Like banks are taking more and more properties back, as John had said, and so I think there are opportunities to step in and get a discounted deal that might not be mass marketed, number one, but that's not aggressive, bullish, buy whatever you can get your hands on kind of strategy. And certainly not betting on expansion, which is what, a debt fund that has lots of construction, that would concern me too. Lots of construction debt out there right now, because if we do have a slowdown, that's the first place to feel it.
I really remember being around in 2008. I was 18 and I watched what happened in my household when the stock market tanked, and how for the following 3 years, you saw deal after deal. It was like, if you had money, you were buying up everything. It was not even a question of like, oh, is this a good deal? It was like, everything is a good deal. Yep. And to me, you're seeing some of the big investors, Warren Buffett, have record, stockpile of cash. Michael Burry closing down his investment fund. You're seeing a lot of these kind of trends, and to me, I'm a little bit more conservative, and I'm sitting in that bucket where where it's like, I want to be investing where it's a no brainer type of deal, and I'm trying to position myself that way to be prepared for that. And with that, I'm going to kind of wrap us up here. If you liked this discussion, all of these hunks are going to be at the Best Ever Conference happening in February in Salt Lake City. And so highly encourage you to come out if you are trying to get educated, trying to become better at being an LP investor. You want to understand what's happening and meet all of these operators face to face. get to shake hands with these guys that you heard today. I highly, highly recommend coming. I think each of us will be giving some sort of presentation. And with that, thank you for joining us on this week of the Passive Income Playbook on the Best Ever CRE Show. Please reach out to any and all of us on LinkedIn. These guys love seeing the love. They need it for their egos. Thank you for joining us. We will see you next time on the Passive Income Playbook.